Before we get into this week's newsletter, we can just jam on the Bitcoin conference a little bit. So Joe and I were there. Unfortunately, Blake couldn't attend this year, but he'll be joining us there next year. And I don't know what you thought about it, Joe, but I mean, obviously I really enjoyed it. It's nice speaking with Bitcoiners, and I was decently surprised by like the attendance. I mean, I figured it would be down because it's a bear market, but I mean, it really was down a lot compared to last year, which I think is a good thing, right? Because that you didn't have, Celsius and your FTX is there, and a lot of the people there, they're on the same mission, right? We're trying to change the monetary system. We're trying to bring about a better money because it'll bring about a better world. And everyone there was really working towards the same thing. So that was my thoughts, Joe. And what did you think about the Bitcoin conference?
Yeah, it was a really good conference. I think I saw the attendance number was like a little over 10,000, maybe 12,000 or so. One thing that I thought was really interesting since we were obviously working at the Blockware booth for a large majority of the time while we were at the conference is 40%, maybe even 50% of all of the booths at the conference were Bitcoin mining companies, right? And I think it kind of just shows what you were talking about. A lot of the garbage in the Bitcoin and crypto industry broadly was weeded out over the last 12 to 18 months. Bitcoin miners are literally the companies that create more Bitcoin. It's like the best way to acquire new Bitcoin other than buying it or providing a valuable good or service to somebody else in exchange for Bitcoin. And so it's kind of very obvious that, hey, Bitcoin mining is, a real industry. If Bitcoin is here, obviously the mining industry is going to be here. And, miners, had a tough 2022, but there's still many of them around and the strongest ones are surviving and thriving. So it's a great conference. Enjoyed it a lot. Enjoyed meeting a lot of you guys, and it was a great time.
100%. Definitely bullish on the future of Bitcoin mining and mining companies. One last point I'll add is I see a lot of complaints online about the conference. Oh, they invited so and so as a speaker, and you just got to remember, Twitter isn't real life. You can curate your experience at these events, right? If you don't want to listen to someone speak, don't go listen to them speak. And if people aren't listening to someone who's stirring drama, then that person's not going to get invited back next year because there's just the financial incentive to invite speakers that people will listen to, right? So if I don't know, vote with your time, right? If you're not a fan of a certain speaker, just don't listen to them. And I personally didn't even actually listen to any of the speeches. I got the best experience I imagined I could have by just talking to other Bitcoiners, right? Having my own conversations. And then it was kind of nice because now in the past week, because I didn't listen to those speeches, I have no shortage of content, Bitcoin related to content to consume. So definitely, if you go to these conferences, I recommend just meeting as many people as you can and talking to Bitcoiners because it's a lot more interesting, and you can really make a more personal connection when you're in person versus online. So those are my thoughts on the conference. With that, we can start diving into this week's newsletter. I know it's been a while because we were off last week, and then the week before that, I think Joe was gone, and then Blake was graduating the week before that. So it's been a while since we've had all three of us up here. So Blake, I'll let you start kicking things off with macro.
Yeah, cool. Yeah, no, it's been a little bit since we were able to do one of these spaces, so I'm excited to get back on here with everyone. So obviously in terms of macro, it's just been a ton of debt ceiling stuff. If you've opened CNBC or the Wall Street Journal or Fox Business or whatever business news source you use, you just see a ton of mostly FUD about the debt ceiling. But it's just, and I say FUD like in the idea that there's a lot of talk about the clock's ticking or time has passed and things like that, and a lot of that has to do with Yellen coming out and saying that the Treasury has until June 1st, or else the U.S. is going to default and send us into the Great Depression 2.0. And I would disagree with a lot of that. And it seems like the market is really convinced that June 1st is not the date. And we had Goldman Sachs come out this week and say it's more like June 9th. Some other banks coming out saying like June 9th, June 10th. So it seems like there's a little bit more time, and it would make sense why Yellen would say something like that, right, and try to pressure policymakers into cutting a deal a little bit sooner than is really the last minute. So, of course, we could be wrong, and it could be come next Thursday, where the U.S. defaults on a, interest payment. But, it seems like the market is pretty convinced that, a week from yesterday is not going to be the day that, we start this sort of, default spiral. But with that, the U.S. Treasury General account, which is kind of like the Treasury's bank account, they hold it at the Fed. That's what we use to fund, most of our spending. Is now it's under 50 billion. So at the time we wrote the newsletter, it was closer to like 70 billion. Now, yesterday the headline was below 50 billion. It fluctuates pretty often, so I would say that the number is slightly arbitrary in the fact that it's close to zero. It normally hovers around 400 or 500 billion. In 2020, it obviously spiked up to the trillions, but it's not great. They're obviously running low on money, and that's this entire debate, right? When the Treasury is out of cash to pay interest, and they miss an interest payment, that's known as a default, right? The Treasury being default. So we've seen the market kind of pricing in this scenario a little bit to an extent. So one way I like to look at this is just looking at yield spreads. So if you look at the yield of these really short maturity bonds, like the 1 month and the 3 month, we've seen that the yield of the 1 month is spiked significantly this week and last week in comparison to the 3 month. And this is the idea that if the US is going to default, they're going to miss a payment on the 1 month bond before the 3 month. So what we're seeing is that the 1 month is selling off. People don't want to hold that bond in the case that the US is going to miss the interest payment. So we've seen that yield spread widen significantly this week, which is just kind of this idea that investors are slightly preparing for this scenario. It doesn't seem to be like everybody's freaking out. And I think if everyone was freaking out and convinced that the US was going to be in this long-term default scenario, I think it would be super obvious in the markets, and we wouldn't see the Nasdaq up over 2% today. So just looking at yield spreads, I think is something interesting, and I think it's important to note what happens if, when I should say when, a deal is struck. I think most people are fairly confident a deal is going to be struck. I think policymakers can put aside their bipartisan tribalism for 1 second to get a deal across the finish line. And there was some news this morning and last night. It looks like a deal is fairly close to being struck, is what I've heard. But of course, we don't exactly know what's going on. But it's important to note. So when this deal is struck, if this deal is struck, the Treasury is going to have to refill their bank account, if you will. And how do they do that? Well, they do that by issuing bonds generally, right? They sell bonds, they sell debt. That raises cash, which they give to the Fed to hold on to them for them in their general account. But interestingly, is normally when the Treasury issues bonds, it's like, who buys them? Well, normally it's banks. Banks go out and buy all the bonds. But now in this sort of market, and we've had this, quote unquote banking crisis in 2023, where banks are short on reserves. So the question is now it's who's going to buy the bonds if banks don't have any, cash on hand to go out and buy them, which I think is, an interesting scenario. I don't necessarily know the answer. There's, multiple potential answers. In a, healthier market, the Fed might go out and buy them. But the Fed's in a QT regime right now. We're not in QE. If we were in QE, the Fed would go out and buy all these bonds. But we're, in this sort of opposite scenario right now. You could see obviously a lot of foreign entities coming in buying bonds. But it'll be interesting to see how that plays out. But one of the things is that banks are going to buy these bonds to an extent. The healthier banks, the bulge bracket banks, they're going to buy some of these bonds to an extent. And the Treasury's already issued, a few bonds this week and last week, or I should say more than a lot of bonds. But they're beginning to try to raise some sort of capital. But what happens is if the Treasury is issuing these bonds and banks, to the extent that they can, begin buying them up, you're withdrawing liquidity from the banking system and thus the economy. So something to keep in mind is that as the Treasury begins to refill their general account with the Fed, they're withdrawing liquidity from the markets. And with the Fed raising rates and potentially pausing them now on June 14th, but with interest rates where they're at, and with the Fed in this, QT regime, as I mentioned, you kind of have this like double whammy effect on liquidity. So I think, heading into the second or the third quarter of this year and into the fourth quarter of this year, liquidity, I think, has potential to become a serious concern for U.S. and global markets alike. Now, that doesn't necessarily mean that we're heading towards back towards lows on the Nasdaq or anything like that. Well, it's certainly possible. It seems like a remotely obvious scenario that liquidity is potentially going to dry up here. So it'll be pretty interesting to see how that plays out. And if you look at like M2 money supply, we've already seen that liquidity is drying up. Monetary liquidity is drying up, right? At the end of Q1, and this isn't necessarily any new news. I'm sure a lot of you have seen this. M2 growth is down to negative 2.6% year over year, which is the largest decline on record. Note that the data only goes back to the 50s, but the largest year over year decline for M2 money supply growth year over year. So it's interesting to see how this really complicated dynamic is going to play out in the markets. But this reduction in liquidity is also being displayed when we look at the banking sector as well, when we look at credit conditions. So a lot of the talk has been that credit conditions are tightening. It's becoming harder to receive credit from banks. And if we look at C&I loans, commercial and industrial loans, we've started to see a decline here in recent months. And that's just banks are less likely to give out credit when it appears that businesses and consumers are less credit worthy or less likely to be able to repay credit. So I think that is another major effect of this sort of environment. But that being said, you can also look at other parts of the economy or just other economic data points that show that we're not in all of that bad of a spot. So one of my favorite things to look at is the Purchasing Managers Index, PMIs. These are like a pretty robust view of how the economy is doing, right? When you see PMIs above 50, that's generally noted as the economy is in a state of growth. When you see PMIs below 50, people generally say that the economy is contracting. But this week we got the S&P Global's flash composite PMI, and that was sitting at 54.5, which was a pretty strong reading and the strongest reading we've had in some time. Estimates for that were 50.0. 54.5 is a pretty strong number. So this is saying that, according to the services and manufacturing sectors, the economy really isn't doing that bad. And I think this is interesting to look at when we're talking about, future liquidity could be declining, credit, maybe tightening. But this metric is saying, based on actual output, when they interview or they survey a bunch of different purchasing managers from around the country and at different sectors, they say that the economy is doing all right. So it's kind of interesting to see like this dichotomy of different metrics. Some of them might be all doom and gloom, but some of them are saying, hey, like it's in reality things aren't really that bad. Did Joe or Mitch, do you guys have any thoughts there?
Yeah, Joe, you can go first if you want.
Yeah, I'm really interested in the whole debt ceiling and talk, or the debt default talk, because I feel like you made some really interesting points there, right? It's like, all right, we're coming up to the point where they need to raise the debt ceiling, and the government needs to issue more treasuries to continue operating like within the set budget that I guess they have today. But it's like, who's going to buy those bonds? And you made a great point. Like, there's not really a clear answer for that right now, and it's interesting because it seems like it's somewhat inevitable, timing wise, is uncertain, that eventually the Fed comes back in and reverses from QT to QE, and they end up buying a lot of the bonds. So it's like, what's the difference between actually defaulting and just like not making the payments, or saying you're going to make the payments but then the Fed coming in and printing the money in order to make the payments? It's kind of like a weird catch 22 when it's like either one's like a hard default and then the other is like a soft default. They're both kind of defaulting in a way if you're going to print the money or just not make the payments.
Yeah, totally. And there's also like a pretty sizable difference between like a short-term default and an ongoing systemic long-term default, like, if you want to look at like the European sovereign debt crisis, right, in the 2010s, that's a little bit of a different scenario than the Fed missing, one interest payment on a 1 month bond, which is, or the Treasury, excuse me. That's obviously a bad scenario, and would have ripple effects across the market. But it's a lot different of a scenario than the Treasury saying, "Hey, we're not going to be able to pay interest for the next year" or something like that. And I don't really think that is even going to happen. I don't think the U.S. will default on interest payments. It's possible. It seems like the news wants to scare you into saying, this time next week the U.S. will be in default. I don't really see that scenario playing out. It's certainly possible, but I just think there's just a lot of FUD in the market, and a lot of people who just the relationship between the Fed, the Treasury, banks, and the consumer is it's really complicated, and understanding both sides of the balance sheet for all of these different cohorts is a little bit complicated, and I think a lot of people don't understand it, and especially journalists who are writing stories about these things. So I think I'm fairly confident, and as well as the market feels fairly confident, that June 1 is not really the deadline. However, those could be famous last words, I guess.
Yeah, I just don't see any scenario in which they don't raise it. If there's one thing that both sides of Congress can agree on, is that they like to spend money and create it out of thin air via debt. So it's inevitable that it's going to get raised. Blake, I'm going to ask you a question because I just want to clarify this in my mind about the Treasury general account. So it makes sense that when this account's depleting, right, that liquidity is going into the market, so that's increasing global liquidity, net positive. But you mentioned like when it increases, that's going to be a net negative. But if it's increasing just from the Fed issuing new bonds, wouldn't that also be net positive for global liquidity?
No. So when the Treasury issues bonds to refill their general account, that money has to come from somewhere. So they're selling bonds, and someone is buying it, right? And generally that's banks. So you're removing reserves from the banking system, which removes liquidity from the banking system and thus from the markets. So generally speaking, when the general account is increasing, you're seeing this net negative effect on liquidity.
Gotcha. Thank you. So, and the problem this year, right, has been low bank reserves. So, wouldn't that continue to be an issue if the bank reserves are getting sucked into the Treasury general account?
Yeah, it would theoretically. So, and that's a little bit what I talked about now is the real question is when the Treasury goes to refill their general account at the Fed, it's who is going to be buying these bonds, because it's obviously not going to be regional banks, right? It is, you could have bulge bracket banks and these larger international banks buying some of them, but likely not to the extent like you would see in a more healthy market and in more healthy liquidity conditions. So it's a I don't really know who's there's a few other different cohorts of buyers potentially, but it will be just kind of interesting to see who these newly issued treasuries go to.
100%. I mean, it'll be very interesting. Yeah, I'm expecting a wild summer. Honestly, if this spring was foreshadowing anything, I think the summer is going to the macro situation is going to get a lot more dicey. But it is interesting how you put this PMI chart in here, and that makes it things don't look so terrible, right? But I guess once we see the steepening of the yield curve inversion, is that something you're looking at right now? Because I know that typically is like a huge sign that the recession is coming soon.
Yeah, you're right. So generally, and there's tons of talk about like the 2 to 10 year spread in 2022, right? That was like a huge talking point. And generally, what you see is that when the spread's negative, you're generally like not quite in this recessionary environment yet. Once that curve flips, as you just mentioned, Mitch, that's generally when you start to see a reduction in output for an economy. So that's absolutely something I'm looking at. But what's interesting is like when you look at markets and you look at like risk assets, the market doesn't seem overly concerned about liquidity in the near term. Like look at a chart of the Nasdaq today. I mean, it looks great. And I should, I talk about this a bit in the newsletter. Like we're super extended over major moving averages here for the Nasdaq. So I think we're probably due for some sort of pullback. And if you look at like the put call ratio is down to pretty extreme low values, which would, indicate that we're also likely due for a pullback soon. But that being said, like the market doesn't care what the put call ratio is, right? Like if there's more buyers and sellers, prices are going to continue going higher. And it's that idea that just because something's overbought doesn't mean that it can't become more overbought. So, I was honestly surprised this week. We saw the Nasdaq kind of looked like it was topping out a little bit. We broke down below the 10-day, but then ultimately, the Nasdaq reversed higher, closed above the 10-day, gapped up yesterday, and then today we're up, over 2%, almost 2.25%. So it's just kind of, crazy, confusing times, right? Where the macro situation might look dire, but, risk assets like the Nasdaq and tech stocks, like don't care what, economic analysts are saying, what they think about the economy, and they don't care about, Wall Street Journal headlines. So it's interesting to see. And, Bitcoin doesn't look all that bad either. For a second there on Wednesday, it looked a little dicey when we kind of broke below this current range that we were consolidating in. But we found support around whatever it was, 24,000 or 25,900 or so. And we're getting a bit of a bounce today. Volume is fairly strong. Just looking at like a 5-minute candle, it looks like we're kind of peaking back up higher here. And I wrote about this newsletter. I think, personally from a technical perspective, 28,000 is kind of where I'm looking at for Bitcoin. I would love to kind of form this almost cup and handle type pattern. But Bitcoin doesn't look all that bad. And yesterday I flipped through a bunch of, altcoins and Bitcoin, and I think Bitcoin far and away looks like the best chart. Ethereum also looks great. And that's just a function of liquidity, right? When Bitcoin and Ethereum are the most liquid assets, they're going to have the, tightest, cleanest charts. But Bitcoin looks, pretty good to me. I think I do think it's possible that we still go down and retest like 25K. But I think things look pretty good heading into the long weekend. What do you guys think?
I 100% agree that Bitcoin looks good, and I guess this will be where we can segue into on-chain. So when you think about what sort of set the floor in November, right? It was long-term holders absolutely refusing to capitulate, right? The weakest hands left the market, and there were no coins left to be sold, essentially. And from there, it's been choppy, but it's been up, and none of that has structurally changed, right? When you look at the hodl waves, and I've got some charts I can pin up in the nest, but also follow along the newsletter if you want to see them all. The supply that hasn't moved in at least 1 year, yeah, the growth rate of that has slowed, but it's still going up. When you look at the 2019 pump, that started to roll over. So you did see some of those longer held coins start to sell into that strength, but we haven't seen any of that happen so far. So like it's structurally still the same as it was at the bottom, right? So that leads me to believe that price, we'll have volatility, but in the medium term, I think up is a very solid base case. And we're about to collide with short-term holder realized price. So that typically is support when we're in more of a bullish state. I'm not going to say we're in a bull market, but we are certainly, structurally things are looking good from an on-chain perspective, right? And price is set at the margin. So short-term holders, whatever they're willing to pay for the next unit is what the price is going to be. And they do have this psychological affinity to buy at their cost basis, right? When they're optimistic about the short to midterm, they're going to buy at their cost basis, and when they're bearish on the short to midterm, they're going to sell at their cost basis because they can break even. And we've already seen short-term holders defend their cost basis earlier. We saw that in March. The price sort of dropped down to about 20,000, and then it shot up 40% in the week after that. So I wouldn't be surprised. I don't like to be like super like short-term bullish because nobody really knows what's going to happen. But I definitely think it's looking good right now. And volatility on the 2 week spectrum is as low as it has been since January, right before we popped up to 20,000. So definitely due for some sort of move here, and I certainly think it's going to be to the upside. And when you look at short-term holder SOPR, so spent output profit ratio, it's just a measure of coins that short-term holders are moving. Are they being moved at a higher or lower price than what they were acquired at? And this during how short price bounces off of short-term holder realized price, you'll also see short-term holder SOPR bounce off of one during more bullish phases. So we've already seen it rebound, and that to me is a good indicator that the next move is going to be up. We saw short-term holder SOPR rebound in March, and we've seen a rebound again here. So I think that's an optimistic sign for the near term. And one more point for on-chain is the reserve risk. So this measures the confidence of long-term holders based on their willingness to sell as well as price. So like how I juxtaposed total waves with the 2019 pump earlier, this is clearly showing a difference between that, which was not very long sustained, and where we're at now, which appears to have a lot more structural strength on chain, right? So you're not seeing these long term holders sell. If you're looking at reserve risk, right, this is essentially a risk reward quantified, and it's really as an opportune time now as it has ever been. So definitely looking to see Bitcoin go up here in the midterm. Again, anything can really happen in the short term. And the last metric I looked at was for derivatives. So I looked at the perpetual futures open interest. And what you've seen before is when we have these periods of sideways price action, because these are perpetual futures, they don't have an expiration date. So the only way to really close these contracts out is volatility. So if we go sideways and we see a large build up, like that's not uncommon, right? If you see open interest build up, that's more people piling into futures contracts. But if perpetual futures open interest is moving sideways as price moves sideways, it's showing that hey, there's not really a bunch of new traders stepping into the market. It's just these existing contracts that aren't being liquidated because there's no volatility. So that's what we've seen recently, which also that sort of lends me to believe that whenever we do have some regime of volatility, there's not going to be like massive amounts of liquidation. Well, there definitely will be futures liquidations, but it's not going to be like the catalyst, right? There's going to be some sort of other catalyst, and it's going to bring on those liquidations. It won't be like, hey, we got slight volatility and then just a massive short squeeze or a massive regime of long liquidation. So nothing too concerning on the derivative side. And that's what I've got for on-chain. I definitely encourage you guys to go check out the newsletter, which is pinned up in the nest.
Yeah, Mitch, I think this was a really great section this week. The realized volatility chart is something that particularly caught my eye. It's very interesting, right? Because it kind of goes without saying, but when Bitcoin's volatility is low or dropping, obviously Bitcoin is going to eventually be volatile at some point in the future. That's kind of a pretty given nature for Bitcoin. But when Bitcoin's volatility drops to the level that we've seen in the chart that you posted within the newsletter, it seems like historically it's been the case that when this does occur, it's either all right, Bitcoin is bottoming like right now, or there's one last washout and we go one step lower and then that's the bottom. So it seems like regardless, this is probably like a great position to be accumulating a solid Bitcoin position. I guess I could see like the scenario going off of what Blake was saying, where maybe we have some sort of quick macro fallout, some sort of debt ceiling drama that briefly sends markets lower, then that gets resolved, and then that's the bottom for Bitcoin, at least in the short to medium term. So I think that was a really interesting chart. The other thing that I really liked, like you said, was the HODL waves. I think that's pure signal. There's not that much going on. Like there's not, I guess, overfitting going on with the data. It's just clearly showing that despite Bitcoin has gone from $16,000 to, almost $30,000, nearly a 2x, we're still seeing a lot of coins not move in over a year. We're basically at an all-time high of coins not moving in over a year. So that's super bullish to me. And I think that was a great chart to point out in the newsletter.
Yeah, I agree. I think this chart is pure signal, and it may be tiresome at some points, right? Because I feel like I tweet this chart like at least once a week, but to me this really is the most bullish and most important on-chain thing you can look at. And I think it's also something that can orange pill normies, right? A lot of their concern is, oh, big, long-term holders, they just, people that are in Bitcoin just want to dump their bags, right? But literally the transparent nature of the time chain allows you to dispel that FUD with facts. If you look every single time there's a drawdown, the only people holding are the people that have been in Bitcoin the longest. So, yeah, hodl waves is pure signal. And then one more point, I didn't put this chart in the newsletter, but you just brought it up. It made me think of it. It's the correlation with Bitcoin and the S&P 500. So using the S&P 500 as a proxy for the equity market, and the year to date correlation is actually negative. And what we saw when the banking crisis happened is Bitcoin pumped. And maybe this is too optimistic of me, but I think Bitcoin's sort of starting to have that reflexive nature where when there's bad news about the traditional financial system and the cracks that are starting to let the dam break, for lack of a better term. I think we're going to see Bitcoin continue to perform well in those scenarios. And I think that the debt ceiling talks and the raising of the debt ceiling could be another sort of catalyst in the same vein, where we see equities either go flat or respond negatively to that news, and Bitcoin just doesn't care, right? No, who's selling Bitcoin right here? It's not the people that are holding the majority of the Bitcoin. So that's definitely something I'm going to continue to keep an eye on, because eventually we're going to have like a complete decoupling, right? If our Bitcoin thesis is correct and this is risk-free sound money, it might take a while for that to truly happen, but it'll definitely happen slowly over time, right? And I think we're already sort of seeing that play out.
Yeah, I saw related to that. Plan B just posted a picture of like pushing a beach ball underwater, and obviously when you do that, the beach ball just kind of pops back up. I think that's exactly what happens with Bitcoin and its bear markets. You see with the hodl waves in the chart that you posted that, despite Bitcoin falling 80+% or 70+%, most of the supply is just not moving and not being touched. And that's kind of like at a minimum of not being touched. Even if coins are moving, it doesn't necessarily mean that people are selling it. People could be moving to a different cold storage solution. They could be opening lightning channels. They could be doing all sorts of stuff. They could be consolidating UTXOs. So when we have these bear markets, we have such little supply truly available that whenever, like you're mentioning, whenever we do have demand step in, whether there's some sort of banking crisis, whether we resume QE, whether the Fed ends up pausing and eventually completely pivoting, that's when demand steps in and there's just simply no Bitcoins available on the market. And that's exactly why we have these parabolic massive bull runs, and the beach ball just can't stay underwater forever. And eventually it starts to move significantly higher.
100%. And before we jump into your mining section, Joe, we could actually run through this Twitter thread that I put up earlier this week, basically explaining why I'm bullish on mining, right? So first things first, if you're bullish on Bitcoin, which I assume most of you are, then that's sort of a prerequisite. I'm not going to go into all the reasons why you should be bullish on Bitcoin, because I feel like most everyone here is on the same page. But this will be specifically why I'm bullish on Bitcoin mining. So the first thing is this idea of ASIC commoditization, which I thank Joe a lot for teaching me about this. And it's the idea that each new ASIC that's released, yeah, it's better than the previous model, but over time that the marginal improvement declines. So the XP, for example, is not that much better than the S19, just the regular S19, but the S19 is much better than the S9. So that's increasing the lifespan of these machines, right? Because they're not being made obsolete by the release of a newer machine. Moreover, that also is decreasing the rate at which hash rate grows. So if you look at hash rate in log scale, you can see that the growth rate's already starting to flatten out. I mean, it still grows, of course, right? Because mining, especially during a bull market, is very profitable. There's incentive to put new machines online, build out these massive facilities, but it doesn't grow as fast as it did in the early days of ASICs. And another thing that's slowing the growth rate of hash rate is the fact that you can't just plug in a new machine to get hash online. You have to build out these massive facilities. You need to source a site with energy and build the infrastructure, ship the ASICs in. It takes time, and you see this lagged effect between when there's a run up in price and when there's a corresponding run up in hash. And with each cycle, we've seen that gap grow. So the longer it takes for hash rate to respond to price, that's more time that incumbent miners are making massive profits. So that's definitely a reason to be bullish on Bitcoin mining. If you want to be mining during the next bull market, which a lot of people are going to want to do, right? If we think Bitcoin goes past its previous all-time high of 69,000, why would you not want to be producing Bitcoin for an electricity bill that, is going to cost roughly 20,000 per Bitcoin? It's sort of a no-brainer. And then, like I mentioned with the ASIC commoditization, it's increasing the lifespan of these machines. So now you have the ability to sell these machines and actually realize that market value, because before there was no secondary value, right? Because the machines would be made obsolete. But now that they do have a secondary market value, and that's why we built the Blockware marketplace. So if you guys have been following along, you know that we released this ASIC marketplace, and we've been really hammering that down because we think this is sort of the future of where mining is headed. On our platform, you can buy and sell turnkey ASICs. So these machines are already online, they're already hashing, and you can pay with Bitcoin on chain or Lightning. And as soon as that transaction settles, that machine's yours. It's hashing your wallet. I bought one. I think it was Monday night, and I just got so excited by it, and I'm so bullish on mining that I went and bought two more on Tuesday. So it's a great product there, and I'm definitely super bullish on mining. And with that, I'll pass the baton off to Joe.
Yeah, thanks, Mitch. And yeah, I totally agree. I mean, if you're bullish on Bitcoin over the next 5 to 10 years, then you have to be bullish on the Bitcoin mining industry. I mean, this is going to grow by multiples and possibly by orders of magnitude if the price of Bitcoin, does go to 100,000, 200,000, potentially even, $1 million and beyond, right? So yeah, I think you hit the nail on the head. The Blockware marketplace is changing the game within the Bitcoin mining industry, and I definitely think you should check it out because it is interesting, right? Like people can log into Fidelity, E-Trade, or Charles Schwab or whatnot, and market buy $1 million worth of Coca-Cola or IBM. But there's never been a way to log into E-Trade or whatnot and market buy $1 million worth of S19 XPs. And now there is, right? Like now you can go on the Blockware marketplace, you can log in, you can simply market buy as many machines as you want, as many machines that are currently available, and it's instant, right? It's basically like within that day or within the next hour, you're going to see those machines hashing to your wallet, and you're going to be earning the reward for it. So it's a pretty cool product, and it makes it this entire industry a lot more liquid, a lot more transparent, and I think it's good for Bitcoin, and it's especially good for the Bitcoin mining industry. But I'll quickly cover the mining specific portion of the newsletter. We talked a little bit about mining pool fees. So this is something that we've been researching for a client of ours. We're kind of diving into what are the different mining pools in the Bitcoin space, and what fees are they charging. Foundry was famous for a little while for being the most popular mining pool, which they still are. They have the largest amount of Bitcoin hash rate compared to all other Bitcoin mining pools. And they were offering a 0% fee to mine Bitcoin. And so, and their pool structure was FPPS, which means full pay per share. And this means that miners receive no variability for their payouts. Foundry basically assumed all of the block risk, and then Foundry obviously charged a 0% fee for doing so. And recently, over the last month or so, they actually increased their fees back above 0%. Now they charge anywhere from 0.15%, so still very low, but you need a lot of hash rate to be in that tier. And most miners are going to be in their higher or I guess higher or lower tiers where you're going to charge a fee of 1.73%. And so very interesting to kind of see how the mining pool industry is going to develop over the coming years. One thing that I think our team expects to happen is more and more players are going to integrate products and services around their mining pool. For example, to use the Blockware marketplace, you're required to point your hash rate currently at the Blockware mining pool. And so that's kind of, I think, how it's going to play out, where mining pools aren't necessarily going to compete on price and fees, but they're going to compete on like what products and services they offer in addition to the mining pool itself. Another thing that we covered in the newsletters is transaction fees. Obviously, if you've been following Bitcoin for the last month or two, you've heard a lot about the ordinals that have been going on, that have been driving fees up for users, and obviously miners have been a huge beneficiary of the transaction fees that people have been having to pay. But it's interesting looking back at the historical chart of Bitcoin transaction fees up until I guess early 2016. There was never really a massive wave of transaction fees. Bitcoin was, still very new. Block space was never very scarce, and it didn't happen until the bull market of 2017, specifically the late bull market of 2017, when Bitcoin fees truly skyrocketed. So we saw people paying, $50 per Bitcoin transaction at the peak of the 2017 bull market. And again, it was kind of very short dude, right? It didn't last very long, but the miners that were operating around then benefited in a very big way. Then we saw the 2020, 2021 bull market, where again, we saw people paying, up to, $50, $60 per transaction. And this kind of fee bull market lasted a little bit longer than the 2017 bull market. It was, most of the first half of 2021, we saw miners raking in a solid amount of fees, but we also saw, exchanges, integrating Lightning, working to integrate Lightning. We saw people batching transactions. So we saw whenever we have these spikes in fees, we see people using the Bitcoin network in more efficient ways. We see block space being utilized in more efficient ways. And I think that's kind of going to be, a staple of what we see during the next bull run. I think we're going to see fees eventually spike again, especially when the price of Bitcoin goes up. And then we're going to see more exchanges integrate things like the Lightning Network. We're going to see popular scaling solutions like Fedimint, grow and be more used. Maybe we'll start to see mining pools pay out miners over the Lightning Network. Definitely something that's in the cards. But recently, going back to the ordinals topic, we saw fees on the Bitcoin network spike close to $30 a few weeks ago. Unfortunately for miners, it's gone down a significant amount. Fees are now less than 10% of the total block reward again, which from my perspective isn't too surprising. I mean, as a miner, you're basically long transaction fees, right? So you want fees to go up in order to, make more revenue. But, when you look at something like ordinals, it's like, it's cool that we made fees for like 2 days that were significantly higher, but it obviously don't, in my opinion, I don't think it's a sustainable source of transaction fees, at least in, the short term. But I do agree that if Bitcoin adoption is to grow and we will see, more people buy and hold Bitcoin, I definitely think we're going to see a lot of, more, fees occur during the next bull run in a very serious way. And obviously it would be great to be a Bitcoin miner at that point.
100%. I think it's pretty likely that during the next bull market, the whole time we're going to see fees that are greater than the block reward. I think we're nearing that tipping point because one, the block reward's obviously going to be cut in half, so it's going to be 3.125 BTC per block, and then this isn't even theoretical. Demand for Bitcoin is just increasing, right? It's up only. So during the next bull market, that's going to be even more so the case. Block space remains scarce. Like transaction fees are going to be the majority of revenue in the next bull market. And I don't really think that's a bold claim. What are your thoughts, Joe?
I definitely think they're going to start increasing, right? Like 2022 was the year of counterparty risk, especially in the Bitcoin and crypto space, right? We found what happens when people, kind of put their Bitcoin in a black box, whether it's something like BlockFi, Celsius, or FTX, and even GBTC, right? It revealed the importance of self-custody, or at the very least collaborative custody with some form of proof of reserves, where you can see your clear Bitcoin on chain, and you don't have to trust BlockFi, trust Celsius, trust these startups in the Bahamas to hold billions of dollars worth of Bitcoin on their ledger device. So it's definitely something that I think is going to be a trend of people, moving to self custody, people moving to at the very least collaborative custody, where they can see that their coins are held by a variety of firms or institutions in the market, and they don't have to trust one single startup in the Bahamas to manage all of their money or to hold all their Bitcoin securely. So yeah, I think we're going to see another wave of adoption where there's going to be 5-10x more people holding Bitcoin, and then those people are going to be using some form of secure solution to actually custody and hold their Bitcoin without having to worry about their Bitcoin disappearing.
I agree. I've got one more. Well, I've got two more questions, Joe. I'll tee up one first, and then after that, I'll ask the next. But do you think in the short term we'll get fees back, like sort of where they were around the 2% mark? Because personally, I'm looking to consolidate some UTXOs. I mean, there's a delicate balance right now. I'm mining, so I want high fees, but I also want to consolidate my UTXOs. So do you think we'll get lower fees in the near term?
That's a great question. I mean, Matt Odell, if you guys follow him, he's famous for saying, the mempool will never clear, or yeah, that it will never clear again. And then, like a month later, the mempool ends up clearing. And I guess for those that don't know, the mempool is where all pending transactions sit, waiting to be mined by miners. And there's a fixed amount of block space for each Bitcoin block. So if transaction volume soars and a lot of people are looking to move Bitcoin on chain, there's just not enough space in blocks to put those transaction in. So people start competing and increasing their fees to get their transaction included in these blocks. And yeah, and so now we've started to see fees coming back down. It's a great question. I'm one to say that we're probably always going to have the mempool clear at some point, but there's going to be spikes, and it may be longer periods between when the mempool clears and when it previously cleared. But I think with more and more scaling technologies coming out, eventually the mempool is going to clear at some point. It may take a day, it may take a month, it may take a year, it may take 3 years, it may be a while, but I think eventually at some point it will clear, and that's when fees are going to be pretty much zero. So if you have like that very low time preference, you can always broadcast a very low fee transaction, but it may take a very long time for that transaction to clear. So yeah, I mean, to answer your question, in the next month maybe we'll see fees go back to 2%, but also I could see fees trending higher from here, especially if Bitcoin starts to move up, or we see another wave of ordinals or another unique use case for block space demand.
With that, how do you balance the relationship between having many UTXOs and the privacy that brings, but those UTXOs being too small, where if we're in a high fee environment, they're not really usable, right? So, what's sort of how are you thinking about that, and when it comes to consolidating UTXOs?
Yeah, it's a great question. I guess for those that don't know, UTXO stands for unspent transaction output. So this is what happens when someone sends Bitcoin to a Bitcoin address. That's now becomes an unspent transaction output that can be used as an input to another Bitcoin transaction, right? So you can now spend that UTXO to another Bitcoin address. And one Bitcoin address can have many unspent transaction outputs because it's just multiple transactions paying specific addresses. So if you have a lot of UTXOs, meaning you have a lot of these unspent transaction outputs, and you try to spend all of your Bitcoin at once from your ledger or your Trezor or whatnot, you could be paying. Your transaction itself has a lot of data because you have to pull from each of those unspent transaction outputs and combine them all together. And because that transaction now has a lot more data and it's larger, then your fees could be higher on that transaction, the full transaction itself, and you end up paying higher fees to move a potentially a small amount of Bitcoin. So it's a great question, like how do you balance having multiple UTXOs to account for privacy, right? You don't necessarily want all of say you bought Bitcoin from Coinbase and then your buddy sent you other Bitcoin and then you're mining Bitcoin as well, you may not want to combine all of those together to where, a chain surveillance company can easily detect that you are now the same entity, basically, right? Like you don't necessarily want to connect your KYC Bitcoin to maybe potentially your non KYC Bitcoin. And so there is privacy in here that where you want to keep different, transactions separate from other transactions. So there's no uh, evidence on chain that, you're all the same entity. But then again, it's also like you can't have a million UTXOs because if they're so small and fees, start to go up, then you really can't spend them without spending a fortune on just transaction fees. So, I mean, it's a good balance, and there's not a really good answer. It really depends on how big you are on privacy in general. If it's not a huge concern to you, or you've bought your Bitcoin all from the same place, then I don't think it's a huge deal to just have a very small number of UTXOs. If you have, if you buy Bitcoin from multiple places and you're big on Bitcoin privacy, then maybe it makes sense to have 5 to 10 different UTXOs, or maybe even more if you have a significant amount of Bitcoin, to be safe, private, and not have to worry about fees spiking, making your future transactions cost more than they really should.
Great stuff, Joe. I think this really highlights the need for Lightning as a viable solution. And call me a LARP, but I don't run a Lightning node yet. But I'm feeling like I might need to start doing that before the next bull market, because I want to open a channel while fees aren't like super expensive, and I don't want to be reliant on custodial Lightning for forever. So that's something I'm gonna start doing here. But I think this is a good spot to wrap up. The podcast that Joe recorded with Peter Dunworth goes live in 3 minutes, so we'll definitely we'll tweet that out from the Blockware account. You can also find it on YouTube. Just search Blockware Intelligence, any other podcast platform. It should be up there. Do you guys have any closing thoughts before we wrap up?
No, I mean, I think we covered it well, right? I think Blake covered macro well. The debt ceiling idea, Mitch covered on chain well. So no major thoughts. Bitcoin's going to be hyper volatile, I think, over the next 5 to 10 years. I don't think that's going to go away. I think you need a Bitcoin position. I think one of the best ways to do that is by mining Bitcoin. So check out the Blockware marketplace.
Yeah, hell yeah, definitely go check out the marketplace. It's been pretty exciting to see just the increase in liquidity that we've seen, especially this week. For whatever reason, we've had some crazy buyers come in, so it's been really exciting to watch. If you're if that's something you're interested in, feel free to go to that tweet posted up in the nest, sign up, or shoot me a DM and I can help you out that way too. But I want to thank everyone for listening and hope everyone has a great long weekend.
100%. Definitely. If you got any questions, send us a DM. We also posted a tutorial video showing you how to use it, and it's quite simple. So thank you everybody for listening, and we'll catch you again next week.
Thanks everyone.